Hello and welcome into the KE Report. Shad and Corey here as your host, and we're chatting today with Sean Brodrick, editor of Wealth Megatrends and contributing analyst to Weiss Ratings Daily. And Sean, always great to get you on the show to weigh in on what you see going on in various market sectors. We didn't have a chance to reach out to you last week, just couldn't connect, but this week there's been more fireworks. I want to follow up with some of the fireworks from last week that affected the tech sector and some of the uranium and nuclear stocks. And that was the DeepSeek news out of China, their AI platform claiming to be more efficient, claiming to be a lot less cost and maybe not be so energy intensive. So it roiled markets the beginning of last week. Then we saw things balance out. We had a wild Monday. There's a lot of uncertainty beyond just that in the marketplace with tariffs and all kinds of things. But if we just focus in on the tech sector, AI, chips, NVIDIA, that portion of the market, what are your thoughts after the last 2 weeks?
Well, I'm actually bullish on things overall. Last Monday was a wake-up call for Wall Street and for American investment in big tech. Absolutely. But I thought that the DeepSeek news was overblown. We've since learned they were training their model on information they grabbed from OpenAI and stuff, which, probably shouldn't do that because you're exposing yourself to the same errors. And also, they were probably using contraband chips, even though NVIDIA denies it. Of course, NVIDIA would, because they are the ones who sold them the chips. So it was overblown. Nonetheless, it is a wake-up call that you can do things cheaper and faster. And so that is causing a reassessment of how money is being invested in the whole AI sector of tech right now. And so we still haven't worked through that. But one thing we are seeing is that we are seeing investors broaden out. Rather than throw all their money at the Magnificent Seven, they are investing more in the broader stock market and in broader tech. And I sent you guys a chart showing that over the last month, the equal weighted S&P 500 is outperforming the cap weighted S&P 500, that is those larger stocks in the S&P 500, and the Mag 7. So equal weight has outperformed for the past month. This is telling me that Monday wasn't the start of something so much as a milestone along the way of something that was already happening, which is we are seeing very focused investment, focused on just a few things, broaden out to the broader tech sector and the broader market in all. So that's actually kind of a healthy development. I can think of a lot of things to buy besides the Magnificent Seven. That said, across my various publications, we own at least 3 of the Magnificent Seven. It's not like I expect them to go away, but things are changing and you have to adjust to it.
So, Sean, just regarding this AI trade, to me, I think this is something we should be expecting, right? Whether we believe DeepSeek's numbers and no matter what chips they use, fact of the matter is we are most likely going to see improvements in AI in terms of cost reduction and probably energy reduction. And those were the 2 sectors that got hit on the back of that DeepSeek news. It was energy providers and the chip makers. But some of the big tech stocks that are in the AI sector, that they still did okay. They didn't get hit nearly as hard. Some didn't get hit at all on the back of that DeepSeek news when it comes to a AI trade, because all the big tech players are in it. They all are developing their own models. And then we have all these other companies that are developing, in a way, different apps, different uses for these AI programs. Where do you see where do you see the best opportunities for investors in this AI advancement when, look, AI is around, it's going to get more efficient. Who's going to be the winner of it, though?
Right. Well, actually, that's a great question and something that I've been writing about recently. And it's those companies that we're going to have to invest a lot in AI that now will potentially have to spend less. That would include banks, cybersecurity, absolutely. They have to use lots of AI. They might be able to do it for less. That could include all sorts of industries transportation, for example, customer service. These are the industries that might have to spend less. And just to speak to those energy providers that were really knocked down last Monday, and some of them were hit stupid hard. VST, for example, lost like a third of its value. That's crazy. Now, I understand that, AI may potentially use less energy. On the other hand, if the energy is available, what's to stop the companies from like ramping up their uses of AI so they use just as much before? And also, uranium stocks got hit hard because people thought, oh my gosh, this means that we won't need a uranium boom. First of all, uranium demand is actually quite predictable. You can tell because it takes them years to build the nuclear power plants. And this change in AI really doesn't change that at all. So uranium stocks went on sale last week. And then Cameco went on sale even more when we got warnings that Trump was going to put new tariffs on Canada. So Cameco got down stupid cheap. I hope some people bought it because what's happening today, we're seeing uranium stocks bounce back big time because the threat of tariffs has at least pushed off into the distance. And in the meantime, people have had a chance to clear their heads, look at these stocks and say, you know what, some of these things look like great buys now.
Well, Sean, I'm glad you brought that up about some of the utility companies getting whacked and then also the uranium and nuclear stocks getting hit so hard last week and maybe into the beginning of this week. But it does look like they're bouncing back. And I just want to maybe ask you, because before all of this AI mania hit in 2024, there was already a growing need for more power, more electricity demand, not just domestically, globally. And there's areas that are still trying to electrify. There's nuclear plants being built all over the planet. China is very aggressively building out, I think, 60 different reactors over the next 5 years. There's all kinds of Middle Eastern countries, South American countries, and even European countries looking at adding a reactor or two. There's life extensions to existing reactors. So if we just take AI off the table and put it on a shelf, we already needed a lot more nuclear power and electricity. Do you think that this AI narrative was just overblown in the first place as far as its impact on the nuclear sector?
There is some dark part of my heart that thinks that the media pushes out these stories because the people that control the big media organizations want regular investors to sell so they can buy these things up on the cheap. I think that story was so overblown, it's crazy. I mean, just ridiculous. America's demand for electricity, and by extension, the world's demand for electricity, is growing at a ravenous rate. We have more plugged in things all the time. We're using more electricity all the time. Now, we have seen changes that like change things, like when we went from the old-fashioned light bulbs to LED light bulbs. We use less power that way, but did that mean that we use less power overall? No. We just started ramping up more use of power for all sorts of things. This is going to continue for years, probably. It's a big megatrend. And so, yeah, I think that that whole thing was overblown. And so last week was a great time to buy energy providers and certain energy stocks, and you probably have a window for a while on that.
So, Sean, when we're talking about this whole energy narrative, look, you're right. We consistently need more energy. We've needed more energy pretty much year after year, forever, potentially, because of how much we use. It's the mix of energy, where we're going to get it from. The U.S. is still producing a lot of oil. Natural gas is also readily available. But Trump's recent policies where he is shutting down, essentially, or really hand-tying the solar and wind sector, those were actually the fastest growing energy sources. I know they're still small, but they were playing a role in providing more energy. How important is it to understand here that if Trump does really slow down that growth in that sector, then where are we going to get that energy from?
Yeah, well, the man is irrational on some things, and that decision that he made on solar and wind is nearly as bad as the one he made on tariffs. So we're going to have to deal with it. Globally, solar and wind should still be in great demand, but I'm glad that, for example, we took those big fat triple-digit gains in GE Vernova simply because I figured it could run into political headwinds. Now, having said that, I mean, they also build parts for, like, say, natural gas plants. They could come back, but we sold them right at the peak. How often do I get to say that? That was really nice. And so I can find other stocks to invest in that don't have the political headwinds and still have plenty of upside. So that's what I'm doing. I'm not picking fights, unlike some other people we can name. So I'm just going to invest in an industry and a sector that I think is going to have a great year anyway, just avoiding those stocks that might be more politically charged than others.
Well, Sean, when we talk about stocks that could have a good year, it would be crazy if we don't talk about the precious metal sector because gold made a new all-time high last week several times, and it's making a new all-time high today. Some of that's on the uncertainty around all this trade conflict, but what do you make of gold and even the gold stocks finally responding?
Actually, I have a column in Weiss Ratings Daily coming out Wednesday on this exact topic. And there's a bunch of things going on. A lot of it is currency related, not necessarily US dollar related, though I think what happened earlier this week put the cap on any dollar rally for a while. A lot that is happening is the weakness we are seeing in Asia and the potential weakness. Because if there are tariffs imposed by the US on Asian countries, I'm specifically thinking China and India, though you could choose other countries as well. If that happens, one way they can respond is by weakening their currencies. Because if, say, we put a 10% extra tariff on China and China lowers its currency by 5%, that's only a 5% tariff, something they can deal with. What's happening now, and I saw this note last week from TD Securities, they talk about the mystery buyer that is buying a lot of gold, bought it last year as a hedge against falling Asian currencies, and is doing the same thing right now. Now, the mystery buyer is not just one buyer. It's a group of deep-pocketed Asian investors that are trying to hedge their currency risk and are still doing it. And so that is one of the drivers, is the currency risk that's posed by tariffs. And so that's probably going to be one of the drivers going forward. There are other drivers as well. You and I go over them all the time. But I've been pounding the table about gold and miners are finally starting to actually play catch up. I'm feeling great about so many of our positions, really, really happy about them. And I'm really enjoying this. I won't try and play, disinterested person. This has been great for me, great for my subscribers, and I think it's going to continue.
So then, Sean, I have to ask, what type of precious metal stocks do you like? We've talked so much about how the juniors have been lagging. So many comments have been made that you still need to be very stock selective. But is there a certain type of gold stocks, whether it's large miners, small miners, development companies, PEA stage companies, however you want to segregate it, which ones offer the best opportunities?
Well, just looking at our own portfolios, looking at Resource Trader, we added Agnico Eagle Mines again recently, and that's a larger miner and a well-run miner, and it was basically going up more than the other ones. But look at Heliostar Metals, tiny little company working down in Mexico, has that great mine, Ana Paula, that it picked up for a song and a dance. And it is small, but it is outperforming. It is looking good. So I think interest is shifting down the scale now. In my own portfolio, where I play with things that are either too small for me to recommend, or I just buy them and hope my wife doesn't find out about them, the small, tiny stocks are waking up in a big way. So I know that when I talk to you guys, usually I'm saying, well, I'm really only going for the larger to like mid-cap stocks. I am now adjusting my view down the scale. That does not mean that I'm not early, but you can see it coming. You can see capital getting ready to allocate down the scale to the smaller stocks, and that's just going to be incredibly exciting.
Yeah, Sean, it's kind of like what we've seen with the Magnificent Seven spreading out into a wider breadth. We're going to see some of those larger producers eventually trickle down into the smaller producers, developers, and even explorers. When we talk next, it's going to be right in smack in the middle of earnings season, and I have to imagine that in Q4, some of these producers in both gold and silver had a pretty good quarter. We said that the last couple quarters, but last year, the fourth quarter was a bang-up quarter. Do you think that'll trip the trigger of some more analysts to follow the sector?
Well, at some point, they have to wake up and smell the coffee. They can only ignore it for so long. When you look at how cheap gold producers as a group are actually trading compared to cash flow, when was the last time we saw levels like these? These things are cheap, and as the gold price goes higher, they're actually getting cheaper, even if they go up, because they aren't getting quite that move that actually they should be getting, because their profit margins are widening like the Grand Canyon. So yeah, I mean, there should be some wake up calls when earnings come out. Hopefully, we'll be well positioned already to take advantage of that, but we'll see how it goes.
John, do you think that the problem here, and I'm not disagreeing with you that margins are widening and these companies are growing on that aspect, but is the problem that gold stocks have become value plays simply because they're not able to increase production at a rate that I'm sure the market would like to see to take advantage of these higher gold prices? So, quite frankly, it is still just such a play on the underlying metals price rather than a play on growth, which is what a lot of investors are looking for.
That's a good point. I would counter, or maybe not counter, just like point this out, that I'm buying gold miners and silver miners that are increasing production. Those stocks are out there if you look around. And the other thing is that growth, when the market is worried, and fear has been rising in the market right now, when the market is worried, growth starts to lose its luster compared to safety. And what we saw in the past couple of weeks is that Bitcoin is not a place of safety. Now, I say this as someone who owns Bitcoin and has recommended Bitcoin stuff, but those wild swings last week were enough to give anybody a stomach ache. What did gold do though? Gold just kept on chugging higher. That is showing the market something, which is that if you're scared now and you think you might be more scared in the future, you definitely want to own gold. And that means gold miners start to shine because they are leveraged to the price of gold. So that's the way I'm looking at it. You did raise a good point. I just think that the attitude is changing. Maybe that goes along with the general broadening out of investing. I'm not sure, but certainly it's a new thing in the mix.
Yeah, great point, Sean. And there are still select companies that are growing their production profile, either through acquisition or through development. And so it's kind of a stock picker's market where you got to dive through all the names and find the ones that have both growth and exposure to good margins. But let's also wrap up with silver. Silver is finally back in the mid 30s. It's above 33 at the time of this recording. It's been bouncing around in the 31, 32 range, but off to a better start in January and February than it was the end of last year. Does that mean that there's finally some life coming for those beleaguered silver stocks, Sean?
I sure think so. Now, again, I could be wrong. I've been wrong before, but I think everyone should either own the SILJ or look at the individual stocks in the SILJ and figure out what you want to own. Just because junior silver miners are doing great. And those junior silver companies, I think, are really going to shine. I'm more bullish on silver and have been than on gold. And I really think this is going to be a great year for silver. So I definitely want exposure to that. And I'd recommend the same thing to anyone else.
Sean, what about getting exposure to silver through other stocks that have other metals too? Because silver primary stocks, well, there are some of them, there are a lot of stocks out there that are a nice blend of gold and silver or other metals that have that silver component too.
Like copper and stuff like that. Yeah, I mean, sure. Now, copper is really, it's okay, but it's really waiting for like China to, kick back into gear. So it seemed to find a bottom last week again, but it's been in a range since what? August? I don't know. So unlike gold and silver, copper isn't breaking out yet. When that starts to break out, again, a lot depends on what happens with China. But here's an interesting statistic for you, and I haven't used this in a story yet. Let's say that we start to see restriction of global trade around the world. That would be terrible, but it could happen. So that means the US, which has debt to GDP of, I want to say 122%, it's huge. We don't have a lot of wiggle room. It is true we can print money, but we also know that the Trump administration is trying to cut those expenditures as well. So our hands are really tied. But then you look at China and Germany, both of which have had sucky economies for a while, but they have very low debt to GDP. What they could do is they could start printing their way out of it and just investing in a lot of stuff. If they start to do that, and this is a potential, this doesn't mean it's going to happen, but if they did that, that would really light a fire under copper prices because that's the kind of stuff they would be investing in. So I'm not saying it has to happen, but it wouldn't surprise me if it happens.
Yeah, Sean, that would be a wild card that could bring more buying into not just copper, but really the commodity sector overall. Well, I think we'll wrap it up there for today, but we covered a lot of ground here. We've talked about tech and AI and chips. We've talked about what happened in the energy sector and whether it's nuclear or nat gas, we're going to need a lot more electricity. We've also dove into the precious metal sector, looked at the currency effect, looked at the tariff effect, a lot covered here. And if people want to get more thoughts from Sean, definitely click on the link below this interview. It takes you over to Weiss Ratings Daily, where you can see the different subscriptions and services that he offers to reader, where he dives into both the macro and megatrends, but also the micro and resource trader as far as resource stocks. Sean, it's always great having you on the show. And as always, looking forward to our next conversation.
It's always fun talking to you guys. Thanks a lot.